Hey YouTubers, Mike Martin's here, Mike Martin's channel. I want to thank you guys for joining me for my housing crisis segment. I got some really good stuff here. It's a good tie-in analysis by ABC. ABC stands for Always Broadcasting Crap. Anyways, I want to put this out to you guys to understand, it's a good tie-in article between Canada and Australia. And here goes. For the people living down under, here goes. This one's for you. Real estate Australian property prices vulnerable to interest rate shock. Australia and Canada have a lot in common when it comes to property. Both nations have record housing debt and have had surging prices in the two of their key cities. So basically, it's in Australia it would be Melbourne and Sydney, and in Canada it would be Toronto and Vancouver, right? But there are some key differences in housing policy and financial practices that make Australia more vulnerable to a housing crash. These differences have been highlighted by Chief Executive Canada Mortgage and Housing Corporation, CMHC, Evan, who was a keynote speaker of the recent conference hosted by the Australian Housing and Urban Research Institute. In an exclusive interview with the ABC, Always Broadcasting Crap, Mr. Sindel touched on 4 reasons why Australia might be more vulnerable to severe housing downturn in Canada, as well as the key area where both countries are taking a similar approach: foreign investors. Australians have more debt than Canadians. Mind you guys need to know this. Australians have had a housing bull market for more than 40 years now. Their bull market for the housing has just been out of control. It's the standard of living is going down, the cost of living is going up, and wages have been somewhat stagnant. Mind you, minimum wage in Australia is a lot higher than pretty much any other speaking country I know of. So dollar for dollar, their minimum wage is not as bad as in Canada and parts of the US. Australians have more debt than Canadians. Canadian households have a lot of debt. In fact, their debt is slightly bigger than the annual output of their nation's entire economy, 101% of GDP. The debt level is twice as big as it was in the start of 1990s. So this has been going on forever. So this debt mark, look at this. So that is Canada's household debt GDP. It's just maxed right out. Mr. Siddle said in a key concern for Canada's policymakers, "We're not proud of the level of indebtedness in Canada. We're quite concerned about it. It's even higher in Australia," he observed. It is higher, guys, but believe this part is true. Australia's household debt is 122% of annual report economic output. Actually, I thought it was 133, but it's okay. The level has surged much more than 2.5 times, and it was at the start of the 1990s. Australia household debt to GDP. So it's getting out of control. Why? Because people have been riding off the coattails of their mortgage, 2nd, 3rd, 4th mortgages, payday loans. Why is this a problem? Because debt basically spending future income. What you're not doing is you're mortgaging your future economic growth, said Mr. Settle explained. And that's why I was talking to you guys about, I don't remember if you guys remember, there's a debt ceiling. You got a debt ceiling that you have personally, not a country. I'm talking about your personal debt ceiling. And people are digging in, because when you start paying down your mortgage, you start creating what's called as equity. Everybody knows this, you watch my show. You're building up equity, and then your total debt service ratio starts going down because you're paying down your big lump bill. But people aren't doing that. They're riding off the coattails in the equity market and using them as ATM machines. And if you watch my videos for the last 5 years, you know exactly what I'm talking about. So they're basically spending future income. And what you're doing is mortgaging your future economic growth. And I have to reread that again because it's very true. The correlation between high house prices and high indebtedness and a future economic recession is extremely high. Even at record low interest rates, Australian and Canadian households are struggling with the burden of large interest bills. In Australia, this is already showing up in weak consumer spending, which is dragging down economic growth. So a lot of people aren't buying things for Christmas this year. You know what I'm saying? That is the trend that would only get worse as the rates eventually rise back towards more usual levels. So this whole stimulus thing they try to do with lowering rates and to try to stimulate the markets with low interest rates has turned out to be a huge party. But the party's coming to an end, and what's happening is people have borrowed more than they could afford to pay back, and what's going to happen? It's beyond me what's going to happen. That's why I left the big city. That's why I left Vancouver. I mean, I'm not that far of a drive from Vancouver, but I want to be away from those big cities. You know what I'm saying? Australians vulnerable to rate shock, Canada less so. Rising interest rate is another area where Canada may have an advantage over Australia. Not only are Canadian households less indebted, but they also tend to have a fixed rate mortgage. Mortgages. 75% of our mortgages are 5 years or longer. And so even in the event of a rate shock, we only have about 25 to 30% of the mortgages that come due every year and are required to be refinanced and therefore exposed to that interest rate risk, Mr. Sandel explained. When told that somewhere around 80% of Australian mortgages were on a variable interest rate, Mr. Sandel was taken back. That is vulnerability, he responded. That makes Australian mortgages holders more subject to rate shock than they would be here in Canada. So do you remember when I was talking to you guys in trends in the housing market that if you have a variable rate mortgage, that I strongly recommend that you guys talk to your bank to renegotiate and put something on a fixed term, basically something closed off for 5 years. You could do I heard of people doing 3-year term, 4-year amortization, 5-year term, 8-year term with a 30-year full am, or 35-year am, or interest only. So I would have gone with an 8-year. The interest would have been a smidge higher, but you would have been closed off for 8 years, or 5. So I told that to a lot of people months ago, maybe last year actually, I've been telling that to people. So Australia has a lot of variable rate mortgages, and that's becoming a huge problem. Australia's tendency towards variable rate mortgages has seen the strength during the global financial crisis, as it meant most households got an immediate benefit from the Reserve Bank's dramatic interest rate cuts. But it means Australians are immediately vulnerable as global interests rise back to more typical levels. Now, you're probably asking, what's a typical level? 4.5% to 5%. In any normal housing market, you're looking at 4.5% to 5%. Canada insures its banks risky loans and charges for it. Highlighted during the global debt crisis, many large banks are considered too big to fail. Yeah, remember Bank of America, people? And will be bailed out if the housing market crash leads to large losses. Australia's Big Four banks benefit from this implicit guarantee by receiving lower interest rates than they raise money on interest rate markets. Their credit ratings are effectively linked to an Australian's governments. So I think in Australia, if I'm not wrong, if you guys want to comment below in the comment section and let me know, I think in Australia you cannot walk away from your mortgage. I think it's like the UK, the mortgage follows you and haunts you for the rest of your life. There's an incentive for people to lend rather less prudently because they believe they can't count on the government bailout, he explained. That's not a good thing to bank on. Holy crap. Canada also has banks they're too big to fail that would probably be bailed out if they got into trouble, but that's the taxpayers got to take care of that. However, it also requires the bank to take out a mortgage insurance on low deposit home loans. Less than 20% of the deposit. CMHC provides that insurance along with 2 private competitors. At the end of the day, when it comes to homeowners in a house price crash, the government is gonna end up paying for that. No, it's not the government, it's the taxpayers, the working poor, the middle class. Because homeowners and taxpayers are opposed to banks, which we should let fail. I wouldn't mind seeing a couple of banks crashing if they have to kind of fix the economy, because once you bail in the banks or bail out the banks, you're in a lot of trouble because you really didn't experience a proper crash. And the whole purpose of a crash is to have a clean slate to start, and that's not what's happening here, you know what I'm saying? It will be unbelievably tempting for politicians, and I think probably responsible for politicians to help support homeowners in the event of a generalized housing crash. We collect prima for at that CMHC. We contribute about $2 billion a year to reducing the federal government's deficit. In Australia, both lenders and mortgage insurers are privately owned. The government gets no premiums, but would probably still be on the hook to bail out big banks if the housing market crashed and both of those insurers collapsed. CMHC also has a monopoly on control over selling Canadian residential mortgage-backed securities with the control of the amount of mortgage funding available. Now, this goes into CMHC. It's a very, very long article, people. I'll leave a link below because I'm going into 12 minutes here. Both countries have limit lending tax for foreign buyers. Good. Well, let's read this part. While Australia and Canada are tackling their housing affordability problems in different ways, they have tried some common approaches. One has been banking on regulators to improve lending standards by getting banks to use tests when assessing how much prospective home buyers can afford to borrow. Prudential underwriting is the first line of defense, and I think both countries have got better and better at that, said Mr. Sandel said. The booming areas of both countries have also put special taxes on foreign buyers of residential property in Vancouver and Toronto in Canada, and through increased stamp duties in New South Wales, Victoria, Queensland, and Australia. Mr. Sandel said that taxes in Canada appear to have just brought forward some buyers' investments, and foreign demand in Vancouver is back where it was before the tax. There are politically expedited measure, but ultimately not the effective, he said. We know in Canada that there is more speculation, active investment, active being done by domestic Canadians than non-Canadians, and so these politicians aren't the solution. So that's that. I wanted to put this out there for you guys. It's a really decent article. I missed a bit of it, but it's talking about CHMC, whatever it's called. And one thing is following, too, what's happening in New Zealand. They've been following the housing problem there, and the new president, or the new person that's been elected into power, took, I guess, what I've been saying for the longest time. If you want to get elected president of any English-speaking country, talk housing, you'll be elected. And that's what happened. And she got in, and basically what's happening now is no foreign buyers allowed to buy in New Zealand. So let's see what happens with that come January 1st, 2018. Thanks for watching, guys. Let me know what you guys think. A lot of people comment below, so, oh, you forgot to mention this, you forgot. Watch my videos. I got 3,000 videos, so watch them. Thanks for watching, guys. Bye.